Hi, and welcome to an introduction to financial ratios by me, Jim Mahar. Hope you get a lot out of this video, and here we go. So financial ratios are very widely used across the world by companies, by investors, to summarize, to filter, to monitor, and look just to investigate the quality and the health of firms. Ratios are very useful. They help summarize many pages of data into a single number that helps us understand things in a much more quick manner than we can in other ways. They're also used to help screen firms. We can filter, we can look through lots of areas and pick a couple companies that have the things we're looking for. They also provide context that ratios provide much better than just single numbers. For example, let's suppose you have a restaurant and you see a restaurant had sales of $1 million. Is that a lot or a little? Well, it depends on the size of the restaurant. That's something that ratios can help us with. Ratios provide that necessary context to understand what a single number means. Similarly, if it's stock price, $30, is that high or low? Again, we can judge that looking at the PE ratio or the market-to-book ratio. Ratios help us by providing context in a great many methods. So, very important, but very easy too, because you have a lot of experience with ratios. Miles per hour, miles per gallon, beats per minute, parts per million. All of these, you don't even think about and use them all the time. Financial ratios are based on the same idea. You're dividing something by something else. It's simple. We're dividing by earnings per share by price per share, or whatever the case may be. Financial ratios are classified into different categories for simplicity of use. There are liquidity ratios. Liquidity ratios are the beginning one. Leverage ratios, profitability ratios, efficiency ratios, and market-based ratios. If you understand all five of these, you have a good picture of what's going on at the firm. So we'll start off with liquidity ratios. The big three are current, quick, and cash ratios. All of them judge how our ability to make current liabilities, to pay off current liabilities. Leverage ratios look at the capital structure of a firm. How much debt does it have? Total debt to assets, debt to equity, debt to enterprise value, equity multiplier, and times interest earned are five of the probably biggest leverage ratios that you should be familiar with. Profitability ratios, how profitable is a firm? Net income divided by total equity, net income divided by total assets, or profit margin, net income divided by sales. All look at how much we make for what we're selling. Efficiency ratios, sometimes called management ratios, look at how well we're using what we have. For example, how much sales are we generating for a dollar of assets, or how many times are we turning our inventory. Very useful at monitoring management. Market value ratios are often used to value firms. PE ratios, market-to-book ratios, even Tobin's Q look at what a firm is worth. ROE, the DuPont identity ties this together very well. ROE is maybe the most important. It looks at profit margin times total asset at turnover times equity, and it really helps us understand how money is made. Just to review, filters can be used in many ways as filters, as red flags, as management tools, and as a valuation tool. Very useful. Now, they do come with a warning, or they should come with a warning, because you need context for them. You can't just use them blindly. You need to look at comparable firms and have comparable accounting methods at these comparable firms. I often joke about 55 miles per hour. Is that fast or slow? It depends on what you're driving. The same thing. Ratios are useful if you're looking at time series or if you're looking cross-sectionally, but you need to be looking at something. You can't just look at a number in isolation. So thank you very much for watching. For more information, check out financeprofessor.com. Thank you very much.
Created using Powtoon.